Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Kevin Davitt, head of index options content at Nasdaq, to discuss alternatives that investors have when seeking exposure to the currency markets. Kevin, it's great to see you as always. Welcome back to Trade Talks.
Thanks, Jill. It's great to see you too.
And it's been quite a week for U.S. equities and a number of the other asset classes. So before we get into exposure to foreign currency, when you look at the markets right now, what's really catching your eye?
Yeah, like you mentioned, equities have kind of generally been on a tear since the CPI data hit the tape last Thursday. And as your listeners likely know, the narrative in capital markets throughout this year has been kind of dominated by interest rates, and the prospect of a slightly more data dependent Fed and potentially lower terminal rates in the US sparked what could be described as kind of a historic rally late last week. And that positive momentum has carried over, and the outperformance on the part of the Nasdaq 100 has been meaningful. You could see it on the chart that shows relative equity index performance between Wednesday of last week and yesterday's close, and the Nasdaq 100 is a clear leader there. But you mentioned markets outside of that. And so to that point, I've been keeping an eye on the MOVE index, which is a forward volatility estimate based on the 10-year US Treasury options. So little perspective, over the past month, that MOVE index declined by about 20%. Now, to be fair, the index was at the highest level since 2009 prior to the recent decline, but I do read that as a positive sign. And in a related vein, the dollar index has fallen from multi-decade highs. So you have interest rate policy and economic forecasts that are inextricably connected to currency markets. And I'm going to continue to watch currency markets, which remain focused on the relative performance of the dollar looking out into the future.
So, Kevin, if investors are potentially interested in getting exposure to the currency markets, what alternatives do they have, and generally what drives this market?
That's, I think, a really important question. So, currencies are another example of how the derivative markets have evolved and adapted to the needs of individuals, of institutional investors. So, that's kind of my long winded way of saying there's a number of alternatives. You could trade FX futures in a futures account, you could trade FX through a bank platform. There are some hurdles to overcome in both cases. Like, for example, a bank platform by and large are bilateral. So you're trading in and out with the same firm, as opposed to an open exchange platform. FX futures require margin, futures approval, all understandable. There are also equity ETFs designed to track some currencies or pairs. And I'll point out also that Nasdaq offers foreign currency options on 7 majors. Now, the key points here are that they are all US dollar denominated, which many US based individuals, institutions prefer. You don't have to repatriate, just by way of example, a euro yen cross. The Nasdaq products are all European styled. They're all cash settled based on the spot market price at noon Eastern on an expiration Friday, like the third Fridays we've grown accustomed to, and that assumes no Friday holiday, in which case then expiration would occur on Thursday.
So, what products are available and why are you watching them now?
That too, hopefully you can see on the screen the 7 currencies available for options trading, and that should also include the relevant tickers. So you have the Aussie, British pound, Canadian dollar, euro, the Kiwi, New Zealand, and the Swiss franc. And again, they are all relative to the US dollar and dollar denominated, which is important. And your last question, I'm watching them because they are one way that I could get currency exposure without the same degree of potential leverage and risk as the futures or spot FX markets. That's just my opinion. But from an option standpoint, the pricing convention is what option traders are used to. So if you bought an XDE euro upside call for exposure and you paid 2, that works out to $200 because you have your 100 multiplier. Let's say you held it until expiration and it settles worth 5. The account would have the difference credited in cash. It would make $300. I paid 200, settled at 500. And then finally, why is this on my radar? Why will it likely continue to be on my radar? Well, big picture, my interest is piqued when I hear the pound is at the lowest level in 30 plus years, or the euro is lower than it's been in 20 years. And in those situations, I try to figure out if there's some way to gain exposure in a risk defined way that makes sense to me. And there's also been a really strong negative correlation between the US dollar and the broad market this year. So dollar up, equities down, and vice versa. So part of me views long exposure to the euro or the pound, currencies other than the dollar, as a potential equity replacement. And I keep in mind there that typically currencies swing with less velocity than even equity indices, but that's not always the case. So potential proxy for interest rate exposure or an alternative to equity exposure. And I believe that central bank decisions will continue to drive markets across asset classes, looking well out into 2023. So these things are going to remain on my radar.
All right. Appreciate the insight as always, Kevin. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.